It looks like most of these houses are empty. Total ghost town. Is it a good time to be buying a home, and is a housing market crash coming? That's what we're going to be talking about today. New home sales have taken a massive hit in July, much lower than most economists projected for the second month in a row. Both investors and first-time home buyers are just leaving the housing market as interest rates climb and economic data fuel public fears. So is the moment here to buy, or should we be holding out for some prices to take a real dive? There were roughly 511,000 new construction homes sold this last month. And while that may seem like a lot, it's much lower than the 574,000 number of homes expected by analysts. It's also 12.6% lower than the 585,000 sold in June. But it's not all good news for those looking to buy a home. Even though the demand is plummeting, home prices have still hovered over $400,000, with a median home price in July measuring $403,800. However, this is still lower than the all-time high we hit in April of $458,000. It's crazy, right? So will these sky-high housing prices last? Well, if the housing supply is any indicator of the trajectory of home prices, then sellers may be in for a rude awakening. You see, the supply has not only been climbing for the last few months, it hit some numbers that are going to make potential buyers very excited. We now have an estimated 464,000 new homes for sale on the market. So you have a frame of reference. That's the most we've seen since April of 2009. And that was one of the highest months of inventory during the last housing crash. Now, not every market is the same, but it's my opinion that the major exodus of big cities for second-tier and third-tier markets is largely over. Many employers are requiring remote workers to return to the office at least part-time, and this means that these workers will need to live within commuting distance to their previous office. There's also the fact that we are currently in a recession. The stock market has taken a massive hit, and even resilient companies have largely stagnated. Layoffs and hiring freezes have started. This will likely cause a contraction and even the city centers where our largest businesses are located. And I don't think people have yet realized how bad it can get. As an example, rent prices have raised over 40% in several major markets. And that's coupled with the massive inflation we have dealt with these last couple years. Wages have increased a little over 10% in the last year, but that's not enough to cover these new prices. COVID eviction restrictions have largely ended, and many cities are facing an eviction crisis. And the recent surge is only going to be made worse with the upcoming wave of foreclosures we are likely to see. While home prices rose 8% annually in July, that is significantly lower than the 10.7% annual increase measured in June. That may seem promising, but it still won't sound like a housing crash to anyone. So where are we at, and what is going to happen in this housing market? Between 2020 and 2021, consumer savings were at near all-time highs because of government stimulus and social confinement. People were moving to second and third-tier markets due to remote work options. The eviction and foreclosure moratorium led to fewer homes hitting the market, and artificially low interest rates brought a wave of new investors into the single-family real estate market. Material constraints were created by supply chain disruption. This fueled a buying frenzy and a sense of FOMO among millennial home buyers. All of these factors that led to unprecedented home price increases are ending, all of them. And we have barely scratched the surface of their evaporation. And remember, when we talked about the sudden spike in inventory, well, that's just scratching the surface. You have to realize that's before the wave of coming foreclosures, and there are also 1.67 million new homes under construction. That's the highest number of new homes under construction since the government started keeping data. Also, the number of completed homes increased over 9% from May to June, making it the highest number of completed homes in a month since 2007. And you also have to consider that large institutional investors are probably not going to sit around managing properties that have lost value, waiting for the housing market to bounce back, when they can get a better return from investments that require no management. Even flippers won't want to keep cash tied up in losing investments. Think about it. A large flipping company can sit on a house that went from being worth $500,000 to $400,000 for 5 years until the market comes back, or they can sell that original house at a loss, buy a foreclosure for $300,000, and then flip it for $400,000 to break even way sooner. Smaller flippers might try and repurpose those losing houses into rentals, but the big money doesn't work that way. Generally, they just want to get lemons off their books. Just look at this statistic. The number of new home sales has dropped 39% since the yearly high that was in January. You can argue that the mortgage loans are better than they were in 2007. That is true, and we are only sitting on a 4.1% delinquency rate. That is a low level. Consider, though, that's roughly the same delinquency rate as 2018, which had over 600,000 foreclosures. So how long until we start to see some attractive prices? It took the 2007 housing crash 4 years to hit its bottom and start to recover. That was even with the Fed buying up massive amounts of mortgage-backed securities. And the Fed has made it clear they have no intention of buying up mortgage-backed securities if there's another housing market downturn because of what's going on with inflation right now. One of the things we really need to be concerned about is not just the housing market, but the overall world economy. Because of high levels of inflation, the Fed can't use the same monetary tools to reduce interest rates to boost the economy. The Fed has to put reining in inflation as their priority because out of control inflation kills countries. We are not alone in having a recession. World economies are suffering, and in particular, other countries are facing their own worries regarding a real estate crash. If you remember, the last time the real estate market crashed, the world economy went into the deepest recession it had since the Great Depression. The thing that could prevent a housing market crash in some of these markets is if current owners of homes just choose to ride out the downturn, bite the bullet, and lose money in the form of property taxes and upkeep rather than in equities. I personally expect buyers of second homes in Florida to get sticker burnout as they realize the expense of managing and maintaining a property that they rarely use. Many purchase in the frenzy with the hope of building massive equity, or with the fear of not knowing when prices would level out. Well, now that public sentiment has turned, and economic indicators are not looking great for the extended future. There's much less motivation for owners to hold on to second homes. I know you might mention that real estate can be a good hedge to inflation, and it has been for the past couple of years, but it's been so good that things have gotten very frothy. So one thing to keep in mind is some housing markets are more at risk than others for a crash. Some markets may just see a correction, while others have seen extreme price growth that is not supported by the wages of local workers. So let's go into detail on some of the housing markets that are already starting to have problems. Here are the top 6 housing markets to have the highest number of price cuts on listed homes. These include Reno, Nevada, at number 1, with 32% of homes having a price cut. That was a popular place for people from Northern California to move when remote work became available. It offered a cheaper standard of living, a ton of savings on state taxes, and was still within a 4-hour drive of San Francisco. But just as we talked about, a lot of these tech companies are facing big losses in the market and are requiring a return to the office. This has resulted in a lot of these second and third tier markets to lose a lot of interest. Now, Austin, Texas also had 32% of listed homes have a price cut. You probably already know that Austin has been one of the hottest real estate markets over the last couple of years. It got a lot of attention when Elon Musk and Joe Rogan moved there. Also, Oracle moved their headquarters over there. This led to a lot of speculative buying and building by investors, and is one of the markets with the highest home price appreciation in the last couple of years. Next on the list is Phoenix, Arizona, with 30% of their homes having a price cut. This is also one of those cities that has seen a lot of growth over the last few years, but there has also been an immense amount of investors both buying and building in the area. You know, Phoenix was one of those cities I personally considered moving to, but the drought is a real concern for me. Until there's a significant recovery of the Colorado River, they start pumping in desalinated ocean water, or they find some other additional water source, I'll probably avoid investing in the area. I kind of feel the same way about Las Vegas as well. Okay, the next housing market to have the highest number of price cuts on listed homes was Anchorage, Alaska, with 29% of listed homes dropping their price. I think this is another one of those markets that just saw a boom when people were looking to leave big cities due to remote work. Next on the list is Boise, Idaho, with 28% of homes having a price cut. This city seems ripe for a housing crash on a level equal to Austin, Texas, in my opinion. Even with all the growth and price appreciation, I still consider Boise, Idaho a third-tier market. Not to be negative on Boise, I hear good things about the city, and I'm sure it's gotten a lot better since I was last there 20 years ago. I just think these smaller third-tier markets are the most vulnerable to the recession and people being forced back into the office. The next on the list is Ogden, Utah, with 27% of listed homes having a price cut. And I think you're going to see this is all throughout what they call the Wasatch Front, which is a chain of cities in the northern part of Utah. To give you an idea, homes were usually quite a bit cheaper in Ogden, and it was a bit more economically depressed compared to other areas. So I think that's one of the reasons you're seeing it be one of the first affected by the cooling housing market. There's been a ton of speculative buying and building there over the last several years. Much of this is related to a lot of tech jobs moving into the Provo-Lehigh region, but just as we discussed, a lot of these tech companies have been hit hard in the stock market, and we are facing a recession. Let me know what housing markets you guys are all watching right now. I'm happy to go into detail on some of the ones you guys are most interested in. If you're not against hitting that like button, go ahead and give it a tap. Also check out this video about real estate, and you guys have a good day.